Lebanon in 2018 experienced a major financial crisis, characterized by the revelation that its central bank was involved in a massive Ponzi scheme. The bank enticed investors with high interest rates of approximately 12%, leading to a significant influx of deposits. However, instead of using these funds to generate returns, the bank relied on new deposits to pay the promised returns to existing depositors. This unsustainable model is the very definition of a Ponzi scheme. The consequences of this fraudulent activity were far-reaching. The artificially created wealth made the Lebanese people feel affluent, leading to excessive spending on luxury items. However, in 2019, the central bank collapsed, plunging the nation into hyperinflation. By 2022, the hyperinflation escalated to become the worst in the entire world, causing the Lebanese pound to lose more than 90% of its value from 2019 to 2022. Personally, I learned about this situation from a friend living in Lebanon. He shared with me how fascinating it was to observe the crisis unfold. Despite the economic turmoil, people continued to carry their designer bags, wear their expensive clothes, and drive luxury cars, all while waiting in line for basic necessities like bread. These possessions, which were initially acquired during the period of apparent wealth, became the only remnants of a prosperous past. Many people believe that such a scenario could never occur within the United States government. They hold the view that as long as a government issues debt in a currency it controls, defaults and crashes are impossible. Additionally, they argue that the US dollar's status as the global reserve currency provides even more stability. However, these arguments neglect to consider the underlying fundamentals of the financial system and the repetitive patterns observed throughout history. This flawed perspective is based on the assumption that the next decade will resemble the previous one, which may prove to be a surprising miscalculation. There exists a long-term debt cycle, consisting of multiple phases that span over several decades. Currently, we find ourselves entering the next phase of this cycle. Renowned investor Ray Dalio has emphasized multiple times that people tend to assume the near future will mirror the recent past. While history indeed repeats itself, individuals often fail to recognize the long-lasting nature of these cycles. Over the past 40 years, from 1980 to 2020, we have operated within a specific phase of this long-term debt cycle. Particularly in the last 20 years, we have, in the late 90s, a hedge fund known as Long-Term Capital Management, LTCM, engaged in a trade called a relative value trade. In this trade, they would buy and short the same debt instruments for a small difference, often just 1 cent. Since these instruments were from the same issuer, it was considered a risk-free trade. The strategy allowed LTCM to obtain significant leverage and execute this trade in global markets. However, as more traders caught on to this profitable strategy, it started increasing the risk of the global financial system. It is common for market participants to aggressively employ leverage and exploit risk-free trades in order to maximize profits. This behavior eventually led to trouble for LTCM as they began to unravel their trades at significant losses. This put the entire global financial system at risk of collapsing. To avert a crisis, the Federal Reserve assembled Wall Street and instructed them to rescue the big banks that had absorbed LTCM. They managed to shut down LTCM and gradually unwound the remaining trades. This incident serves as a cautionary tale about underestimating the consequences of small beginnings. This orchestrated bailout by the Federal Reserve, even though not directly responsible for the crisis, established a precedent for future rescue operations. This became evident a few years later when the dot-com bubble burst. In an effort to mitigate the economic impact of the bursting bubble, Alan Greenspan, the chairman of the Federal Reserve at the time, lowered interest rates. However, this reduction in interest rates fueled the housing bubble, which eventually triggered the Great Financial Crisis. The response to the crisis involved not only further lowering interest rates, but also printing money to bail out the banks. The Federal Reserve's balance sheet remained burdened with these assets until 2018, when they attempted to offload them. However, this move caused the market to crash, leading Jerome Powell, the current chairman of the Federal Reserve, to reverse course in December of that year. Nevertheless, in September 2019, less than a year later, the market experienced turmoil again, leading the Federal Reserve to intervene and bail out the repo market. And then came 2020, when the COVID-19 pandemic brought about the next crisis. In response, trillions of dollars were printed to bail out not just the banks, but the entire economy, and interest rates were lowered to near zero levels. This unprecedented level of spending and monetary policy measures led to record-breaking inflation. Given the pattern of one bailout leading to the next, along with continued interest rate cuts and money printing, many expect that another economic crisis is looming. Furthermore, they anticipate that the Federal Reserve will once again intervene and rescue the economy. However, what most people fail to consider is the factor of escalation. The previous bailout was so much larger than before that it led to inflation rates not seen since the 1980s, if one believes the official numbers. We are currently experiencing ongoing inflation, indicating that we may be in a new phase of the long-term debt cycle. To understand the potential consequences, let's examine the period from 1940 to 1980. Over these 40 years, interest rates consistently rose, with some intermittent drops. The overall trend, however, was an upward trajectory. Concurrently, the rate of inflation also increased during this period, despite occasional fluctuations. We experienced 4 decades of rising interest rates and rising inflation. Now, let's shift our focus to the next 40-year cycle from 1980 to 2020. In 1981, interest rates reached their peak, initiating a trend of decreasing rates over the following 4 decades. Though there were fluctuations along the way, the overall pattern was a decline, hitting near zero levels in 2020. Similarly, inflation rates decreased during the same time frame, with occasional spikes, but an overall downward trend. Again, hitting near zero levels in 2020. This signifies a 4-decade period of falling interest rates and falling inflation. However, as the cycle turned and reached zero, we observed a reversal in the last 3 years. Both interest rates and inflation rates have started to rise once again. We find ourselves in a context of increasing interest rates and inflation. The next decade is projected to follow a different trajectory than the previous one, driven by a long-term debt cycle. Although there may be periods where inflation rates decrease, the overall trend indicates a steady rise. Consequently, the strategies that proved successful in the last 40 years may not be as effective in the coming years. For instance, passive index fund investing gained popularity in the past few decades. However, this approach was virtually unheard of before. Similarly, long-term bond investing thrived during a 40-year period of interest rate decline. Yet when interest rates start to rise, the dynamic shifts entirely. The 60-40 portfolio, based on modern portfolio theory, is likely to become obsolete. Growth investing will be replaced by income and value investing, as a reversion to the mean is anticipated. This transition is likely to result in substantial wealth loss for many individuals. In the long term, active investing reigns supreme. Passive investing essentially relies on others making the right financial decisions on your behalf, akin to gambling. To effectively navigate the investment landscape, intentional asset selection is vital. Being mindful of one's investments and intelligently hedging against significant losses are essential practices. Ultimately, there are 4 potential outcomes in investing: significant loss, minor gain, or significant gain. By eliminating large losses, one can offset small losses and wins, with significant gains driving overall performance.